Maurice Oduor, who is investment manager at Cytonn Investments, just to help us make sense of these developments. Many thanks for joining us, Maurice, and Happy New Year.
Happy New Year to you, Happy.
Well, quite a tight year it was 2017, 2018. What's your sentiment of the year ahead?
If you look at where we are coming from the year 2017, of course, election came in to complicate already a complicated year. It's a year that was characterized by high inflation rates, mainly driven by food component of the CPI. It was a year that also we saw the interest rate cap was coming into effect full, and we saw banks now retreating backwards in terms of how they disburse loans. We saw the lowest growth on private sector credit growth ever over the last 5 years. As at October, it was about 2%. Remember, government usually targets about 18% private sector credit growth. And if you look at all that environment now, even the providers of credit, which are mainly commercial banks, were choosy in terms of who they were giving loans to. And a reflection of this we saw in many the performance of commercial bank. All of them reported a drop in profitability, except for two, which was KCB and Stanbic Bank. And also these one were mainly from the operating environment where they were in Southern Sudan, where they now sort of like a recovery. But if you look at this, the effect that we saw in real estate was mainly most investors were adopting a wait-and-see approach. And again, banks not disbursing loans to the real estate sector. But if you put all this in totality, the fundamentals that still support the performance of real estate still remains there. Remember, the president during inauguration, the emphasis is now going to be the 4 pillars. One of the pillars, the provision of affordable and quality housing,
Correct.
Which again will continue supporting the real estate sector. Again, when GDP growth statistic came out for Q3, we saw again the strong growth in real estate, mainly driven by construction, and also the real estate activity within the real estate sector again continue supporting the economic growth. But if you look at from the development IRR perspective, still remain as high as 25%. And again, this one has to be backed by research, and you have to be also choosy in terms of which themes you are playing in to continue that, to ensure that you get that levels of return.
All right. And away from real estate, Maurice, what are some of the key issues that will be facing, especially the securities exchange? We've seen the NSE performance hasn't been very promising in 2017. Should you expect further rebounding of investor appetite at the bourse?
If you look at 2017, if you put into reality everything that was going in 2017. In fact, in 2017, the stock exchange recorded a very good performance. Market closed at about 28 and a high of 28%, which means if you invest in the beginning of the year, we record a return of 28% for that year. Going into 2018, what you are likely to see again in the effect of interest rate cap still will remain with us, because we look at the way policy decision makers, the kind of statement we are getting from it, it's likely that this one will remain with us. What we expect to see is a bit of like amendment, but not doing away with it totally. And again, if you look at the banking sector, 2018, we are going to now again, in terms of reporting standards, we are going to IFRS 9, which now again means bank will have to provide more. And again, that will affect profitability, and also will affect even in terms of the capital adequacy ratios. And if you look at, again, the provision, how banks will again continue disbursing loans to other sectors that again will continue supporting growth, they are going to be choosy with the interest rate cap. So putting everything in totality, 2018, markets already trading at par in terms of the historical standard. We are likely to see slower growth compared to what we saw in 2017. But look at other performance of the economy, given that now we have the government in place, elections are over, we are likely to see better economic growth in 2018 compared to 2017. But we are likely to see the impact of electioneering period in the first half of 2018.
All right. When you say we're likely to see the impact of the electioneering period, what does this mean? Do you expect hyperinflation? How will this affect cost of maize flour? We've seen the government subsidy program has come to an end.
Because if you look at the power, the lagged effect of events that will happen in an economy, like for the GDP growth for Q3 came at about 4.4%. Remember, even part of Q4, we were still in an electioneering mood. Again, you'd like to see a slowdown in terms of GDP growth for Q4. And even if you look at all the effect of all these things, again, we'll have to reflect in either between Q1 of 2018, Q2 of 2018, which again will still record a slower growth compared to what we did last year. But we are likely to see a pickup, especially from second half, from July going forward. And if you look at in terms of in inflation currently is about 4.5%. Average for the year came at about 8%. And if you look at the trend in terms of the food component of the CPI, that is on a downward trend. The key thing that again now will determine the direction of inflation rate mainly going to be the trend in the oil price and the global markets.
All right. And right now, Maurice, one of the other critical issues that Kenya is facing, of course, is the debt.
Yes.
Where IMF is saying that we've exceeded the ceiling, if I would say so. What are the implications of this for the Treasury now that you're seeing there's another set of projects that the government intends to finance? And from a tax perspective, what way forward in addressing our taxation needs for funding development? At the same time, issues of being within manageable levels of our debt to GDP ratio.
If you look at the debt levels for Kenya, we already surpassed the 50%, which is the threshold prescribed by IMF for the developing and emerging markets economies. But there are two things that need to put into perspective: where we are going to get debt from, and again, what we are going to use this money we are collecting to, how we are going to apply them in terms of economic activities. If you look at borrowing, we are mainly, over the year, Kenya has become appetite for government for foreign debt has significantly increased. And the key thing, remember when during around October, there was information came out that government was not able to service the maturing dollar of syndicated loan they got in 2015. Sure. And now they were negotiating with them, the investors, so that they could extend. Some of them refused, but again, they have gotten another loan that now they are going to use to pay off these other investors who could not extend the maturity. So going forward, what we're supposed to do, because the debt we're already now moving into a territory where we're supposed to be a bit more cautious in terms of debt to GDP. What we are ensuring, even if we have mega infrastructural projects, we're supposed to scale them and do them within our means, so that we don't shock the economy. Because as much as we are going for these euro bonds and those syndicated loans, which are dollar denominated, we are opening up economy to external shocks, which now means whatever happens in other markets will directly affect the Kenyan economy. The key thing that we should not forget is that the first batch of the euro bond is maturing in 2019, which again, government needs to start preparing in terms of how they will fund that. Yes.
And CS Rotich has been on record saying that our debt levels are within manageable confines. What's your take on this?
It's within manageable confines, but what we need now to put into perspective is the public finance management framework to ensure that as we are borrowing, we are moving to debt to GDP of 50%. These funds are channeled into a use that now will again affect the lives of Kenyans. What you are seeing, as much as even if you borrow to fund for the standard gauge railway infrastructure projects, the effect of this will come slowly. It will not have like an immediate effect. What we need to do is that we don't shock the economy. We scale it so that now we do it in bits, and again now we continue having benefit from this. But of the key thing, as government is moving to a debt to GDP of 50%, the question we should ask ourselves: who is now funding the private sector? Because we are seeing banks now have also come to a situation where they prefer giving money to the government as opposed to funding private sector. And private sector is the key driver of any economic activity in any country.
All right. Yes. And finally, what does the year hold for the SMEs?
SMEs, they are going to be still struggle. We have to be there in terms of how they access funding, because banks will still remain choosy and still discriminate on them in terms of advancing loans, which will affect the performance of that sector. And what we need to do to address the SME situation in terms of access to credit, we need to ensure that we come up with what I usually call specialized banks that funds, especially banks that will be issuing loans to specific sectors of the economy. Because as Kenya, where we are, we can't do away with the SMEs, because SMEs, in terms of job provision, in terms of economic activity, they control significant portion of the Kenyan economy. And again, going forward, we need to ensure that we work on a different funding structure so that we reduce the dominance of banks in terms of provision of credit to an economy. Look at developed markets. Banks also provide a funding of about 40% of the total loans in an economy. But in Kenya, we are in a situation where banks are funding almost 95%. What we need to ensure we reduce that dominance by banks so that at least SMEs and also other investors in the economy could access credit easily from other avenues.
All right.
Yes.
Many thanks, Maurice. Looking forward to a great 2018.
Thank you.
Well, that is Maurice Oduor, investment manager at Cytonn Investments, just giving us some interesting insights on the economic performance in 2018 and what some of the sectors will be critical in developing, in actually driving growth for the economy. We want to take a quick commercial break. We still have much more coming up after the break.